everybody. Now we'll be doing a SBR question from exam kit. Okay, and it is, you can say, it is one of the past paper. All right. First thing first, always remember in the exam questions that always before looking at the scenario, look at the requirements. Okay, so explain how Jacinta company should account for the credit impaired loans in the financial statements for the year ended 31st December 2006. Okay. Your answer should include journal entries and it will give you 8 marks. Okay. Then we have second requirement. Explain how the revenue from the internet service contract and the sale of equipment to share company should be accounted for in accordance with IFRS 15 revenue from contract with customers. We will get 10 marks. And then finally, we have the last requirement. Explain, here the calculations are also required, how the sale of inventories would be accounted for in the individual financial statements of both Jacinta Company and the overseas subsidiary at 1st September 2006 in the consolidated financial statements of the Jacinta Group at 31st December 2006. And we will get 7 marks for it. Okay. So now we are moving to the scenario. What the scenario is saying? Jacinta Company is the parent company of a group. Its main business in the telecommunications sector, but with the continued expansion of the product and services, it has also developed a credit risk management business. The financial year end is 31st December 2006. We get our year end. That means our counting period, the year start from the January. The functional and presentation currency of Jacinta Group is in dollar. The following exhibits provide information relevant to the question. Loan portfolio describes the purchase of credit impaired loans by Jacinta Company. The revenue and inventories describes a 2-year service agreement with their company and the sale of inventories to an overseas subsidiary. Okay. So the Jacinta Company purchases credit impaired loans and a measure this at amortized cost. Jacinta Company correctly calculates. Okay. Jacinta Company purchases credit impaired loans and measure this at amortized cost. Jacinta Company correctly calculates the loss allowance as changes in lifetime corrected credit losses since initial recognition of the asset, which is effectively the change in the estimated cash flows on 1st January 2006. Jacinta Company bought credit impaired loans with a remaining term of 4 years. Jacinta Company paid 32 million, which is equivalent to the fair value. At 1st January 2006, the remaining contractual cash flows expected to be received on 31st December each year are expected cash flows in X6 is 8.8 million in 2000X7, it's 8.8 million in 2000X8, it's 8.8 million in 2000X9, it's 8.8 million. So the credit adjusted effective interest rate on the above cash flows is 3.9% per annum during the year ended 31st December 2000X6. 8.8 million was collected at 31st December 2006. The credit worthiness of the loans has improved. Jacinta Co. now expects the following cash flows to be collected. Expected cash flows 10 million, 10 million, and 10 million. Okay. Once again, look at the requirement, explain how the Jacinta Company should account for the credit impaired loans in the financial statements for the year ended 31st December, your answer should include journal entries. Okay. So let us start with the solution now. So our question is, name is Jacinta Company. Okay. And we are doing the first requirement, the part A. Okay. So part A, that is our financial asset. Now, what we will say that IFRS 9 financial instrument requires recognition of impairment losses on forward looking basis. Okay, which means, okay, it means that impairment losses are recognized before the occurrence of any credit event. These impairment losses are known as credit losses, expected credit losses. Now we will give the uh, accounting treatment of the standard. So we will say IFRS 9 says, or IFRS 9 requires that a loan should be reported with its risk of expected losses Uh, Regardless of whether the loan is materialized or it will materialize in future. Okay. Now, further we will say the purchase credit impaired financial assets. Now we will connect it with the scenario. So we'll say that the purchase credit impaired financial assets are recorded on initial recognition at transaction price. Without the presentation of an allowance for expected contractual cash shortfalls because expected shortfalls are included in the purchase price. So what we will do, our in on initial recognition, on initial recognition, journal entry required is debit loan asset 32 million and credit cash 32 million. Let us make the calculation table. Okay, remember that in examination you just have to do on the calculations we have to do on a spreadsheet and the theoretical part in the Word. So now my table here it is opening effective interest, which is given in the question, that is 3.9%, the cash flow and closing. And this is for 31st December 2006. What is my opening value? That is 32 million. Okay, apply 3.9% on it. We will get 1.25. Okay, what is cash flow in dollars? It's 8.8. The closing value is 24.45. Okay, so at 31st December 2006, Jacinta company would calculate interest income of dollar 1.25 million by applying the effective interest rate that is the short form of 3.9%. Okay, now what is the entries for it? Jacinta company must record the following entries. What is the entry? Debit loan asset dollar 1.25 million. Credit profit or loss account 1.25 million. And next is debit cash 8.8 million and credit loan asset 8.8 million. I hope you're getting it right. So further, we have to explain to the examiner that the amount recognized as a loss allowance as a loss allowance for these assets is not the total amount of lifetime expected credit loss. Instead, but instead, the change in lifetime ECL since initial recognition of asset. Finally, we will say the revised expected cash flows should be discounted using the original expected interest rate and compared to the original expected cash flows as at as at 31st December 2006. So my headings, my cash flow, the discount factor, the present value. So for 31st December X7, 8.8 million, it's 3.9% discount factor is. So for year one, it will be 0.962 and present value is 8.47 million. For 31st December X8, for 8.8 million, 0.926 and our present value is 8.515 million. Okay, that these are all in millions. Okay, 31st December X9, 8.8 and the discount factor is 0.892, 7.85 million. So we get previously on the previous cash flows, our present value is 224.47 million, right? It's previously, by the way. Now, the revised one again, the date. Okay, my next heading is cash flow. Next heading is discount factor. No change in rate, 3.9%, and the present value in millions. Okay, so again, the date 31st December 2007, 31st December 2008, 31st December 2009. We have each 10 million, 10 million, and 10 million. It's 0.962. It's 0.892. We will get present values 9.62, 9.26, and 8.92. So the total is the current present value is 27.80. It's currently. Okay. Finally, what we will say that the resulting favorable change in lifetime expected credit losses is therefore $3.34 million. How? Previous Currently it's 27.8 million. Previously it was 24.47 million. So an impairment gain of dollar 3.34 million is recognized in profit or loss at 31st December 2006. So our entry was debit loss allowance 3.34 million, credit profit or loss $3.34 million. Finally, in the end, our closing statement and is at 31st December 2006, the following amount will be recognized in statement of financial position. So loan carrying amount will be 24.45 million. Is $24.45 million. Loss allowance will be debit balance of $3.34 million. So that's the answer for this part of the question. Okay. What we get in the marking scheme, the the marks for this is for this part, that is the initial recognition of IFRS 9, we got 3 marks out of 8. Okay. So for this area, let me highlight. For these area, in that is the in IFRS 9 principles, IFRS 9 principles, 3 marks. We got for these areas, we got 1 mark, 1 mark, and 1 mark. Total 3 marks were there. Then for the initial recognition, these areas, we got how much? 2 marks, 5, including the double entry. Okay. Then for amortization part, amortization cost or the movement in this amortization cost from these area. Again, we got 2 marks. And the finally, for this area, the movement in AECL from here till the last. We got 4 marks. So that's how it covers our 8 marks. Right. So far, so good. We are done with the first requirement. In the next session, we'll be doing next requirement.